unprecedented times, with news narratives being more negative than positive. Investors have also been caught into a whirlwind of emotions, negative developments, and psychologically challenging times. This impacts not only our inner peace, but also how we approach our investing journey. In the second episode of the Calm Allocators, we shall once again try to stay calm while we figure the innate rationale behind the market movements. Joining me in this conversation is Mr. Sahil Kapoor, the Chief Market Strategist at Edelweiss. Sahil has been decoding market movements for more than a decade now. But what stands out for me is his realization of his own bias and his ability to constantly question them. So Sahil, welcome.
Thank you, Ankita. Thanks a lot.
As I was saying, there are a lot of negative biases that have been developed around us. Up until the end of March, we were looking at markets and the concern was how much more will they fall. And it turned out that the consensus was much below the levels that markets actually consolidated at. And since the recovery has begun, the question is, this has to nosedive. It's just a matter of time. So do you think so much pessimism in the market is justified?
So I think 2020 has been a absolutely different year from what we've seen earlier. So one thing is that there has been events one after the other, a number of events which are extremely rare. You don't see these events happening again and again, like the health scare due to the pandemic and then the lockdown to contain the health scare, which induced a huge amount of economic cost, not only in India, but globally. And then we had this whole episode of financial sector fragility, many episodes playing out with cooperative banks and other scheduled commercial banks. And then there was this whole episode of job losses and salary cuts, which is still going on. There is a threat in the economy. Now there have been a few threats of conflicts and wars over the last 2-3 weeks. Trade wars have, resurfaced and come back. So I guess there is a plethora of negativity around, and a lot of investors, I think, have used that negativity and probably, magnified to some extent or probably superimposed it to investing universe.
True.
I think people are trying to, see this whole negative scenario play out in their investments also, which it did. I think in March and April, markets took a nosedive. They fell significantly. But I think at this time, a lot of people would want to see what's happening in the, let's say, in the society, in the main economy, get reflected in the stock prices. But I think one thing is very clear. Stock prices chase profit pools. They chase expectations. They chase emotions. So stocks are not what is today's headline.
True.
I think stock prices and financial markets are much more than that. And I think for right now, people should be looking at data, the hard facts. They are very, very important. So my best guess is I think data will reveal a lot more than emotions or short-term expectations. So I think this year is probably an important year to be more realistic, more data-driven. And let me ask you, what are you looking at in terms of data? What is the data revealing to you?
So Sahil, the turnaround in data has been much faster than it was previously expected. So even if let's look at numbers, we saw retail sales in US bounce back to 18% on month. But I think the internals were really important there. So apparel sales were up some 188%. Home and furniture sales were up about 90%. So it kind of shows the pent-up demand and the willingness of the consumer to want to consume as and when there is a window and the lockdown lifts up. If we look at unemployment data, and not just the US, even in India, as per the CMI survey, in April, we lost about 110 million jobs. In May, we gained back about 21 million of them. Again, mobility trends have picked up. In terms of hard facts, NHAI FASTag collections, which when rolled out in February were about 1,800 crores. They dipped to a record low of about 200 crores in April. And now they're back to 1,100 crores. And I think it's been how the data has spanned across industries. So even if we look at like core industries, so our cement, steel, power, all of them are producing about 80 to 85% of their pre-COVID levels already. And I think these numbers will only improve as the hotspots of Maharashtra, Gujarat, Delhi, and Tamil Nadu open up more aggressively. So basically, the high frequency data has been showing an uptick from the ABIS, and it marked a lot of positive surprises. It was able to beat the consensus. But Sahil, what do you think is the bigger factor here that contributed to turnaround from the expectations?
So I think the key word here is the consensus. So I think many people felt that this is once in a lifetime or once in 100 year or even more, a depression kind of a economic outlook. As you said, the recovery has been faster than expectation. So I think it's a case where what people thought and what reality is. I think the reality is a little bit better than what a lot of people expected it to be or what they thought it could be. I think the key driver here is what kind of economic stimulus is governments across the world providing and how central banks are managing the liquidity. I think these two factors are important along with the reopening rate. One thing is very clear. I think that this whole situation is going to get better completely or going to go away, the whole negativity, only once you find a cure or a vaccine or a therapeutic. But the idea is that meantime, what kind of growth support is provided? So if you look at the total global GDP, it's at about $80 trillion. And right now, US is giving a stimulus of about 24% of its GDP, the highest since the World War II.
Yes.
Eurozone is also similarly giving one of the highest stimulus in last 100 years. Similar facts are available for Japan and many other countries. So if you total up the whole fiscal stimulus, the number reaches about 8 to 10 trillion dollars, which is a very large number, going beyond 10% of global GDP. And then you add what central banks are doing, like Fed is pumping huge amount of liquidity, more than $3 trillion if you put all the programs together. So if you put, Fed, Bank of England, ECB, Bank of Japan, all the major central banks of the world, the global stimulus from monetary policy or the lessening of friction in financial markets is exceeding more than $7 to $8 trillion. Again, a very, very large number. So I think what these two numbers have done is provide a cushion. If you, I think right now there is an analogy going on that this is like a precipice or a big ditch which has been caused because of the virus in the economic growth trajectory. So these two stimulus are trying to fill that up, give that backstop. And there is a big contrast available. Countries which have given smaller stimulus like India, I think the recovery rates are a little less. They are smaller, but nonetheless, you could still expect the governments to come back and do more fiscal expenditure. But you see that underperformance, that lower recovery in countries which have given lower fiscal stimulus, which is available. But on the whole, I think the global stimulus is one of the key factors why the recovery, as you said, the reopening recovery is faster than many people expected. That is the key. And I think another very important factor is how the global reserve currency, which is the US dollar, has behaved. In prior crises, we've seen dollar shooting up, seeing a huge amount of risk averseness. This time, I think with what Fed has done, reopening of economy and cooling off of trade tensions, dollar has come down. It has slipped. I think the dollar is down from about 103 or so on the dollar index to as low as 96. It did shot up initially and then went down. But the last few weeks or 1.5 months, the dollar weakness has really helped the global economy, commodity prices, emerging markets. I think that is one of the key right now. So fiscal stimulus plus the dollar weakness. I think these two are very, very important. So let me ask you, a lot of people focus on what the dollar is doing, what oil is doing, and therefore how the Indian economy will get an external shock or an external benefit. What do you think will be the dollar's role for India's growth?
Sahil, as far as this year is concerned, I think we are very favorably placed in terms of our external situation at least. I think we've already established in our conversations that EM outperformance is linked to the dollar. But more so on the economy context, there's a very interesting trade angle that could play out this year and could help India stage a growth. So as you mentioned, with the stimulus and weakening of dollar, I think the global demand will revive. And since our own stimulus has been subdued relatively, our domestic demand is likely to struggle for a longer period. So what this means is that exports could revive much faster than imports. And even if we look at the limited 2 months data that we have, in April, both exports and imports had contracted at about 60%. In May, exports had contracted by just about 35%, whereas imports continue to contract upwards of 50%. And even India's imports is also lagging the whole emerging basket average. So it kind of shows the subdued domestic demand. If at all we can play the global demand, and if we can increase our exports, of which we are seeing the green shoots already. So the India's trade balance, inclusive of goods and services, could turn out to be neutral to positive. So this trade balance has been taking away about 4% of India's growth in the past. So if this number turns neutral to positive, at least one leg of the growth will fire in FY21. It could also, as you mentioned, get more momentum from reduced cost of imports as the oil prices fall. So both dollar weakness and the fall in oil prices will reflect in a favorable trade balance for India, which could help bringing back some amount of growth. As far as FY21 is concerned, I think we are working with about 0% nominal growth for the year, and the real growth is likely to be negative. But we also think the most of the pain would be seen in the first quarter, where we could see growth falling to upwards of 30%. But going forward, recovery and the repair would start much faster. But having said that, growth is likely to be missing or likely to be subdued, and inflation is also likely to trend downwards. The sense is that interest rates will also trend down, which means the bond yields will continue to fall. And equity valuations currently look a little out of context because of the fall in the expected earnings in FY21 in particular. So, Sahil, what do you make of the whole intermarket scenario and in the current situation, and how you would, as a calm allocator, allocate your portfolio?
So, Ankita, I think this is the true test of an investor right now. And if you believe in asset allocation, I think this is the year where you have to be very, very calm. Two things. First is that you generally have to take a valuation call when there is such a big uncertain event which plays out. And then there are a number of events, as I said earlier, 5 to 6 events. Many of them are unprecedented, once in 50 years or 100 years or so. So you have to really take a valuation call that this is the price and this is the value where I would want to allocate money to a specific asset class. And I think 2020 has given ample opportunity to allocate to equity markets. And over the last 2 months, we've been saying that you allocate 5 to 7%, take your incremental equity allocation to 2/3. That means if you have 100 rupees extra to put into equity markets, put at least 66 out of that. Just keep 35 cash. One thing is very clear. There will be a lot of volatility, not only in stock prices, but also in economic data. Because I think the reopening or the way the economy unfolds, it rises like a phoenix from its ashes. I think there is going to be large amount of changes that we can't fathom today. So those changes will cause a lot of volatility. So I think 2020, you should be using that volatility. And we've used the often used term in US of buying the dip. So I think this is the market where you buy the dip and not sell the rallies in equity markets. And that should be the strategy even for the rest of the year in 2020.
All right, Sahil, I think we have a lot to learn from your mantra of buy on dips rather than sell at highs. And you've been very much saying it that we need to go take the staggered but a consistent approach to our portfolios in these times. On the ending note, I think we'd like to highlight that though this crisis has similarities from the crisis of the past, it is also different in a certain way, and that is that the end to this crisis is a known variable. It probably lies in abating the virus either through medicines, vaccination, or through herd immunity. So until then we get to that point, the idea is to stay calm and make sure that we are not getting swayed away by the recency bias. So stay calm and stay invested. Thank you.